I hope by now you have read the Steve Allen story, wanting to sell his firm and so forth and so forth. Please note which of the items in the question are actually variable costs, and we have fixed costs as well. And so Steve expects sales and revenues to grow by 20% in the 3 years following 2013. Now, if you look at the problem here, 2013 is the statement that we are given. 14, 15, and 16 are the projections. Revenue increases by 20% each year. So if we multiply 15,000 by 1.2, we get 18. Multiply by 1.2, we get that, and so forth. So some items move by 20% as well. Cost of goods sold increases by 20% a year. Marketing and depreciation and interest costs all increase by 20%, whereas general and administrative expenses remain constant, as you will see. So doing the problem in that way, we can project 2014, 15, and 16 quite easily by multiplying these variable items, increasing them by 20% each year, taking care to leave the fixed items at their fixed costs. So you can look through this one and you will see. And we end up with the net incomes. And so it will take a little bit of time to get it done, but the basic problem is quite simple. So we end up with net incomes, projected net incomes for 14, 15, and 16, but real incomes for 2013, which was the statement we were given. We have another problem, which is the weighted average cost of capital. I don't know if we have spent much time on this one, but the equation at the top, WACC, the W's, WD, WE, and WP are the weights or relative amounts of the capital components. The general equation, which is this one at the top, makes room for debt, equity, and preferred stock. Our problem does not have preferred stock in it, and so we can just drop off this third expression. What our problem does have is two different debts, and so this equation will be the one we'd use to solve our problem. Because we have short-term debt and long-term debt, it doesn't matter which one is which one, as long as we get the numbers right. So we would have the relative amounts of short-term, long-term debt, and equity. We have the costs of equity, which has no tax benefit, so T doesn't appear. But debt gets a tax benefit, so the impact of tax is factored into the cost of debt. So effectively, debt has two costs. It has a before tax cost, which we'd call a nominal cost, and it has an after tax cost, which is the real cost that the company pays. Because even though it would have to pay the bank, say, the 10%, when it files its returns, it can claim back the tax benefit, get a refund, and so effectively reduce the cost of debt. And so our question gives us the various costs of debt. You'd have seen it in the table, 10% for short term, 12 for long term, and 18% for equity. So we have the K's. We have the tax rate as well. What we didn't have is the weights, the relative amounts, but we can find those pretty easily. We just total up the financing for the firm, which when you add up, look at the table, when you add up the 400 for short term, 600 for long term, and 1 million for equity, comes to $2 million worth of financing. And so this is how we find the relative amounts of each. We simply divide the particular item, short term, by the total amount of financing, long term, by the same. And so we have the weights. We plug the weights into the equation, 0.2%, or 20%, or 0.2, for short-term debt, which has a nominal cost of 10%, 0.1, And this is the tax impact. 1 minus t becomes 1 minus 0.3 because the tax rate is 30%. Same thing when we get over to long-term debt. The weight is 30%, 0.3. The cost is 12%, 0.12. And the 1 minus t, same 1 minus 0.3 as we had for short-term debt. For equity, there is no tax advantage. So we have the weight, 50%, 0.5, times the cost, 18%. When we solve this equation, going through these various steps, we get the weighted average cost of capital, 12.92%. So it had three different costs of financing, 10% for short term, 12% for long term, and 18% for equity. But as it turns out, the average cost couldn't simply be found by adding up 10, 12, and 18 and dividing by 3. We'll have to do a weighted average because we have different amounts of each, 20%, 30%, 50%. So the weighted average cost of capital turns out to be this number. Thank you.